grew up in Latrobe, and I see some familiar faces. They've already heard this story before, but grew up in Latrobe, went to college at Duquesne, graduated with a degree in accounting, then went on to New York University, got a certificate in financial planning, and got my certified financial planning license. From there, I went into high net worth consulting, so I worked with clients on their trusts and estate planning and their investments. Our smallest client was about $5 million. Our largest was about $250 million, so we had about 50 clients we work on. From there, I made a jump into, was a bad jump, but I made a jump to brokerage side of the business. It really wasn't my taste. I really didn't like it, and left there and started working in operations for a small hedge fund. And we're going to talk about hedge funds a little bit today. We're going to talk about mutual funds. We're going to talk about ETFs. Like, this is going to be all about kind of public markets and what stocks have to offer, what bonds have to offer. He sent me a whole checklist of kind of things that I'm going to try and touch on.
Sorry.
No, it's fine. I'm going to try and touch on them as best as I can. Did that for about 3 years, and then started my own investment advisory practice here in Greensburg as well as downtown Pittsburgh. It's called Catan Ferretti Financial, and we're not even going to get into the insurance side, but also an insurance brokerage business here locally as well, but we're not even going to touch on that today at all. So that's about it. That's about me. So what I'm going to do is I'm going to try to break this up. Probably most of it at the beginning is kind of like a high-level educational about security markets, the exchanges, different types of stocks, different types of bonds, and those types of things. And then I'm going to show you actually what I do. I've got some screen shares up and things that are of computers that are sitting on my desk currently, and I'm going to walk you through kind of this whole transition of where markets were, where they become, and then kind of how we do business now, which is very unique, but I hope you guys can find that interesting, and we'll have a little bit of fun with it. But let's talk about the different exchanges. So there's many different types of security exchanges. What I have up here is the New York Stock Exchange. Is kind of your main big one. It's where the bull sits. That's where, well, there used to be traders on the floor throwing around, yelling at each other, doing all the hand signals. It's now all computer based now. There are no people here really anymore. Just if you ever turn on CNBC, you see a bunch of people behind computers. They're called market makers. So basically what they're doing is they're looking at the screens, and there's orders coming in from people like me, from large banks, and they're matching those orders. So they're matching buy orders with sell orders, and they're making sure the markets are running efficiently. Most of that's done by computer now, but still in the case of stock being halted, and let's just, for an example of stock halt, you have Amazon is about to announce that they're going to take a rocket ship to Mars, and they'll halt the stock to let everybody kind of understand what's going on. They'll halt the stock for maybe 5 or 10 minutes, and then the market makers will kind of be responsible for making sure everything opens smoothly. So that's kind of the New York Stock Exchange. It's the most popular. It's all the tickers you see. I mean, every single stock trades on the New York Stock Exchange. $5.
Entry fee.
Yeah, I'm just kidding. So this is the CME. What the CME is that's where all the futures market trades, or all the futures markets trade. I think trading in futures is really, really cool because trading just in the stock market, you're kind of limited to buying shares in companies and owning shares in their stock and betting on their different directions. What's cool about the CME group and what's cool about futures is I can bet on energy or metals or corn or soybeans or OJ. And what futures are is May? Is it May?
Yeah.
So I can bet on the price of what orange juice might be in June or July or August. And this is really important for large companies. I mean, the CME group and the futures exchange is so important to our overall economy and how things work because let's say you're a large orange juice manufacturer and you do not want to take the chance that maybe the cost of oranges is going to be super high next year. I mean, you have to control the cost of your good in the store. So they'll go out and buy futures on the exchange and try to lock in their price. So they kind of have an understanding of where their margins and things are going to look like and how much revenue they can generate with all of their expenses. So have you guys have you guys learned about Southwest Airlines at all? I mean, you know who they are, but have you guys gone over a case study on Southwest at all?
We just mentioned them a couple times in here, Bob.
So the reason Southwest Airlines is the airline that they are today, there's a couple of different reasons. One is because they bought all the same planes and made servicing them a lot easier. But the second reason they were able to grow so quickly is because they made a really big futures bet on the price of gasoline, and jet fuel. And they were right, and they took a risk, and the cost of fuel was so much cheaper than the rest of their competitors that they just kind of took off as a group. So I do some trading personally in at the CME group, and I'll show you a little bit of stuff later. But futures trading is you're betting on, instead of individual companies and stocks, you're betting on things. Agriculture, I mean, you can bet on, I shouldn't use the word bet, but livestock, grains. I mean, I can go in here and see what the price of a future for live cattle is $106 at open today. You know what I mean? Like, so it's kind of fun, and people are able to buy things or lock in certain prices, and that's what the futures exchange is. Do we have any questions on that? No. All right, I'm going to show you this because this is fun and it's hot to topic. This is the GDAX. This is where your Bitcoin trades, your Litecoin trades, your Ethereum trades. This is the newest thing out there. This is where all the fun is, where people are kind of playing cowboys and trying to make a ton of money on this. And I'll show you some different things, and I'll talk about a project I'm working on with this right now. It'll tie in a little bit later. What you see, and this is kind of cool, they're actually showing you live orders. What you have up here are people making, they're the sellers, right? They might be holding Bitcoin or something that they want to sell, and down here are your buyers, and they're matching these orders together, and in real time. You're seeing what, it's a little hard to see, there's no big orders coming in, but it'll show you the depth of the market, and what that means is like how much somebody is willing to offer, how much someone's selling on that side of the trade. They try to match it together. What this is kind of the chart, and right now I'm short. It says 5 minutes. So every 5 minutes, it's printing one of these bars on a chart. Okay, so you can kind of follow the price from 8 a.m. today to noon. And just really easy reading one of these is, if we take this for an example, this is where that 5 minute chart opened. Okay, whatever this is Bitcoin then traded all the way down here, recovered, and then closed up here. So it actually increased in price during that time. On the reverse side, you have, maybe take this here. This is where it opened. It traded all the way down here in this 5 minutes, and ended up closing here until we moved on to the next bar. Does that make sense? Like reading a chart. So that's how you read these candlesticks and bar charts. And the reason why I use bar charts instead of line charts, a lot of people look at line charts. The reason I look at bar charts is it's much more telling. I know that this is, are you guys familiar with the terms like bullish or bearish? So bearish means I want to bet against something or it's out of favor. Bullish means I want to buy something and bet on the price going up. This is a bullish indication, and the reason being is because, look, it traded all the way down here, but someone bid it all the way up, and it actually closed higher when it could have kept going, and you can see the continuation of the move there. I mean, that might be too much information, but it gives you more insight than just little dots on a chart or lines. All right, that's that. We'll talk about the different types of securities. So I am, I'm a financial planner, and I have to use all the tools I can in my toolbox in order to give somebody a diversified portfolio. So there's stocks, there's bonds, there's cash, and then there's inflation, different types of inflation securities. Now I can talk about all the different types of stocks. I mean, there's growth stocks, there's value stocks, there's small cap stocks, there's mid cap stocks, there's large cap stocks. And I'll show you some different things there. But you've probably heard the word in the term, diversification and asset allocation. And what that really means is we have to take a certain amount of stocks and a certain amount of bonds and a certain amount of cash to help someone build out their portfolio. So an aggressive investor might invest 90% of their money in stocks, and maybe 7% of their money in bonds, and maybe 2% of their money in cash. So you can build out this diversified portfolio. But I'm going to just give a couple different examples of some stocks. Let's go to Morningstar. If you ever need any information on anything, stocks, mutual funds, ETFs, Morningstar is your place to go. They're leaders in research and all the thing alike. So let's look at Facebook really quick. Facebook's a stock, it's a company, it's a tech stock, and it's also a growth stock. So tech is its sector. Facebook, being a company, and a growth stock is, we expect Amazon to be aggressively growing and innovating, and the difference between kind of growth and value is a value stock is something like Walmart. It's been around forever. You're buying it for value. You're buying it to get some income. You know that they're going to continue to grow and increase value, but probably not at the same pace that Facebook's going to be able to grow, and that's why it's a growth stock. One day Facebook might become a value stock. It's just not there yet. But if I scroll down, man, they've totally revamped this since the last time I was on it, which is kind of nice. Where am I at? Statistics. I'm just going to walk you through this whole thing really quick. Again, I told you I'm flying by the seat of my pants. So financials, have you guys gone through income statements, balance sheets, all that sort of fun stuff? Here's your financials. They're going to give you a snapshot. You'll be able to click down here at all financial data. Kind of breaks all this out for you. So when you're looking at Facebook, you can see, okay, in 2013, you can look at the revenue in billions, and you can see how it's grown significantly. Year to date, they've already done $40 billion in revenue. And you kind of look at all of these things, and what a fundamental investor does is a fundamental investor is looking at financials and saying, okay, look, here's how much revenue I expect them to do. Here's what their net income looks like. What is their earnings per share? And I'm going to attach a multiple on that, and that's how I'm going to derive what I think the price of Facebook is. So when you hear someone's a fundamental investor, what they're looking at is this fundamental business data. They're looking at income statements, looking at balance sheets, they're looking at who the owners are. Do they think Mark Zuckerberg's a good leader? Those types of things. Down here, so valuation, price to earnings. What price to earnings is the price of stock divided by the earnings per share. And they have this all listed here, something a fundamental investor definitely will look like. Same with price to cash flow and price to book. What price to book is the price divided by the book value of the company. So the stock price is not the book price. The book price on a balance sheet is what the company was worth that day if they liquidated everything. What the stock price is basically what they look at the price to book, price earnings, and then they attach a multiplier to it. What somebody's going to think it's going to look like in the future. So that's what that is. We don't need to go through all of this. Ownership. It's kind of interesting thing here. So ownership. Who owns this thing, right? Like, who are the top owners? Vanguard Total Stock Market Index owns the most. The Vanguard S&P 500 Index, they own the most. And then who's your executive team? And this is really interesting. A lot of people keep an eye on this. Is what are the owners and the board of directors and the key executives doing with their stocks? And it's funny I picked Facebook. So Mark Zuckerberg, I'll show you something really quick. How he's going through all this stuff? He was on Senate Hill and they were grilling him, and they're kind of in trouble. This is FinViz. And people keep an idea and look, and if owners are buying and selling shares of their company. Here's Mr. Zuckerberg right here on April 26th and 27th selling $67 million worth of stock. So he must be a little bit nervous. But FinViz is a cool little site, financial visualizations. I'll come back to this. But so that's a stock. Let's look at a mutual fund. I haven't even traded a mutual fund before. It's American funds. So the difference between a stock and a mutual fund is a mutual fund hires a manager. Say they hire somebody like me to go out and pick what they think the best available stocks are to put in a portfolio, and they're going to hopefully outperform the market. What a mutual fund is they take a basket of everybody like you would put money into this fund, and then I would manage it on your behalf. thing about a mutual fund is it's very, very specific as to what they're allowed to do. So this is the American Fund, Growth Fund of America. It is the most popular mutual fund in the world, and it's a large cap growth category. So this manager is only allowed to invest in large cap growth companies, and he wants to try to pick the best large cap growth companies. The one problem with mutual funds, well, there's two problems with mutual funds. Two problems with mutual funds is the fact that they're not as liquid as a stock or an ETF. And what I mean by that is that if I own the American Growth Funds of America, and God forbid, Kim Jong-un fires a rocket in the air and the market crashes, and I want to sell this, I can't sell it immediately. I can only sell it at the end of the trading day. So when I put in an order to sell my American Growth Funds of America, that trade is not settled to the end of the day, which kind of opens you up to the possibility of an adverse situation occurring in your portfolio. The second thing is, and remember when you get jobs and you have a 401k and all of that stuff, remember that how important this is. This is, the fee level, expenses, and the load. And what the load is how much money they're going to take from you before they even invest your money. So this load is 5.75, and they conveniently don't put a percentage point there. But if you give them $100, they're going to take $5.75 right off the top. So not only do they have to outperform the market, they have to do so while charging you 5.75% upfront for your money, and they're going to charge you 0.64, or as we call it in the business, 64 basis points every single year to manage your money. It makes it hard to kind of like compete and grow your money, and it kind of puts a little bit of speed bump on you. So if we compare that to what an ETF is, this is the most popular ETF in the world. The SPDR, they call it SPY. What SPY does, and what the SPDR does, is it tracks the movement of the S&P 500. So what an ETF manager does is they go out and they buy an exact, as close as they can, match of an index. So you can do it on the S&P 500, you can do it on the Dow Jones, you can do it on Japanese mid-cap securities, you can do it on, literally you can buy an ETF now on anything. Before this market took off, it was kind of smaller, but ETFs have absolutely blown up. And the reason they've absolutely just blown up in size is because, one, they're very easy to use. You kind of know what you're buying. Two, they're extremely cost effective. There's no upfront fee, and the expenses are 0.09. They're very, very small, but they're liquid. If I want to buy and sell SPY every second, I can. Actually, people trade them every millisecond, all the robots and algorithms. I'm going to show you some algorithms later. That's an ETF, that's why people trade them, and these things have exploded. They've absolutely changed the financial advisory industry. We use ETFs solely and only. We don't have any mutual funds. We don't trade individual stocks anymore. We are a full-blown ETF manager, and I expect it to be the industry to be that way for a very, very long time. Let's see where else am I? Let's talk about, I guess, bonds really quick. Bonds are basically it's basically a contract. If I want to build there's three different types of bonds. There's a municipal bond. We'll talk about two. Municipal bond, which is a bond between me and a municipality, or me and a federal agency. So if I, as a municipality, want to build a new school, I need to issue a bond and take on debt. So I go to all of you and say, hey, we need $30 million. Will you guys loan us $30 million? We'll pay you an interest rate for that. The nice thing about municipal bonds is generally all the interest and income you receive from a municipal bond is tax-free. So a lot of people who make bond investments do so in municipals. The other types of bonds are corporate bonds. So a corporation wants to build a new building or whatever. It's the same. It's the same concept. They borrow money, you give it to them, they pay you an interest rate. The only difference there is that interest is taxable. You have to pay tax on that. Does that make sense to everybody? So basically, when you're building a portfolio together, you want to get riskier investments, your stocks, your ETFs, your mutual funds, and then your more conservative bonds, municipal bonds, and just like I showed you a stock mutual fund, they have bond. I'm actually surprised how many people showed up with the last day of class. You guys are awesome. Yeah, it's the Bond Fund of America. So instead of you having to decide what bonds you want to buy and individual bonds I want to put in my portfolio, American funds will go out and they will pick a bunch of bonds that meet there. Let me see. I'll show you the portfolio here. So, what's in this mutual fund? Before I buy it, I want to look at it. There's a lot of good stuff I can talk about here. I don't have the individual underlying holdings. What's in it? So they're holding, 7% and 7% cash. 92% of the portfolio is in bonds. What's the average credit quality? So how safe are these bonds? They're all A-rated, which is the best. You want A-rated quality. If as you go down the scale, B, C. I mean, there's AA, AAA, but you go down the scale, the lower the letter, the less safe that investment is. But the lower the letter, like if it's a C-rated bond or a double B-rated bond, the interest rate will be higher because there's more risk inherent in that. You can see, okay, what types of bonds are they holding? So 41% of their portfolio is in government bonds, U.S. Treasuries, things that are issued by our government. Corporate bonds, 30% of the portfolio is invested in corporates. Agency mortgage-backed securities, which I'm not even going to talk about because it's too much. They hold some of that. So you can see what's in these, and I can look up, a junk bond fund, and it's going to have a totally different makeup. So it's just a nice way to get exposure to a whole bunch of different things without having to actually go out and hold them yourself. Does that all make sense? What stocks have to offer, I talked about that. What bonds have to offer, I talked about ETFs, I talked about mutual funds. Let's really quickly talk about hedge funds. So the difference between mutual funds and hedge funds are very similar. What a hedge fund, though, is private. It's not traded on. You can't actively buy it. So I would go to a room full of accredited investors, which they have to make $250,000 a year and have at least $1 million in assets, excluding your personal residence. And I go, hey, look, I don't want to start a mutual fund. It's too expensive, but I got all these great investment ideas. Look at all my returns. Look how well I performed for the last 10 years. Give me some money, and I'm going to pull it all together in a company, in a limited partnership, and I'm going to manage that for you, and I'll charge you a fee to do so. So they're private entities. You'll hear all the time about these mutual fund, or these hedge fund billionaires, and why do they make so much money? It's because they go to the richest people in the world, the richest countries in the world, they pull their money together, and they charge them, not only just a management fee like I showed you, but also a performance fee. So if I make let's say my performance fee is 20%, if I make $1 million in the portfolio that year, I'm going to take $200,000 in profit of that piece of profit for myself. So that's how they're kind of different in that manner. Okay. So I talked about some fundamental stuff. Let's talk about some indicators and technicals. So 50, 100 years ago, everybody was trading and making investment decisions based on fundamental data. So they're looking at, income statements and balance sheets, kind of like I showed you. Now, that had kind of progressed to looking at different technical indicators like volume or support and resistance lines and moving averages and kind of all of these different things, and they kind of give you an idea of what they expect a stock to do. I don't know if these pull up some indicators or not here. If not, I can do it on my machine. It's too hard to see. Let's do this. Oh, that's wrong. Okay. Can you guys see that? No? A little bit? This is actually one of my monitors on my desk, and I'm just screen sharing it in. And so I can start to study this. Instead of looking at, we talked about the bar chart, this is the S&P 500. Actually, it's SPY, the ETF I showed you, which is a replication of it. And you're seeing this is from 2010 to 2018 and what it's done. And we talked about the bars and all that. But what's it really tell you, right? It's hard to kind of just just guess. So people do different things and they have different studies. So I can kind of click in here and I can add a study, and let's say I want to look at moving averages. You guys are all familiar with a moving average, right? Let's do a 2-line moving average. It's so hard to see. Let me kind of zoom in. Zoom in here. That's still hard to see. Sorry. But basically what a moving average is it's looking, in this case, we have two different moving averages. One's a 30-day and one's a 60-day moving average, and it's looking back 30 days and saying what the average price of that security was, and then it'll look back 60 days and what the average price of that security was. And some people look at this and say, well, when the 30 days starting to decline and it crosses over your 60-day moving average, you're just going to start to see some decline and some pressure in the market. So it can tell us a little bit more than just looking at all of these different charts. But we can go even a step further. People look at things like, when analyzing charts, they love to draw lines on the graph or lines on the chart, and so there's a term in trading they call support and resistance. So when you're looking at different charts, we can find, and I drew this line here, where some support is. So you see that it's tried to come down, but it hasn't really been able to break through this area. So there's some support there. There's people buying it there. There's some buying pressure, right? So that's a technical indicator that we don't think that the market's going to trade below that for any reason. It's hit this area 4 times and people have bought it, and it's continue to go up. Without drawing them again, there's a resistance. I can put a resistance line here. As it hits that line, it had trouble breaking through there. And once it breaks through support or resistance, generally a trend continues. So that's how kind of technicals and those types of things work. Also, that's about it. And then volume would be the last one. So somebody looking at technicals would try to understand volume. What volume means is how much buying and selling was done during that time period. So if there's a ton of, if there was a day where the market was up 4%, but volume was nothing because no one was really trading it that day and only a few people were buying it and bidding it up, it's not as strong as if there was a ton of people buying it, right? So people look at support and resistance and these moving averages and how much volume is behind these things. How many people are convicted and have conviction that this is going to move? How many people actually took money out of their pockets and made the bet, right? So that's kind of the technical side of things. In the last 10 years or 15 years, it's gone from technical to quantitative. How many, I've glazed all of you over. It's gone quantitative. And what does that mean? It's gone to math-based and computer-based investing. Most people are still stuck. How do I delete these drawings? There we go. Move drawing objects. So it's gone to computers. It's gone to algorithms. Looking at all of these different indicators that these moving averages and volume and breadths and all of these different indicators, and they put them into a computer program and they analyze them absolutely instantaneously in order to make an investment decision. And what that does is make everything a lot faster, and it takes emotion out of the equation. I can draw lines on this chart all day long. In fact, it's hilarious. I'm going to show you TradingView. TradingView is a site for where traders go, and they sit around and talk to each other all day about where they think the market's going to go. Most of them are wrong, but you can see they love drawing. They love drawing lines on a chart like all day long and trying to guess. Like, this guy is crazy trying to figure out what's going on, and they're emotional about it. They're drawing all these lines saying, okay, I think it's going to go up here, but I don't know, and I'm not really sure. But there's support here, resistance here. I don't know what to do. And I mean, it actually is kind of, I mean, it's like all day long. They draw these lines on the chart. So what quantitative investment has done is said, okay, let's take all of this information, let's take all of these different indicators, let's pick the ones that we really like, let's weight some of them higher than others, and we'll build an algorithm that can watch it for us and then trade on our behalf so we don't have to make those investment decisions anymore. And it's completely changed the industry. And we were one of the first to move in that direction, and we're the only quantitative manager that I know in Pittsburgh, Greensburg area. I mean, there's obviously guys in New York and Miami and Chicago and all those fun places, but let's have a little bit of fun here for a second since I've bored you all to death with markets 101. But I hope that's what you were looking for.
Absolutely.
Okay. All right, so I'm going to add a study here that's not going to look like the others. Where's the box go? So, add a study. Why is it doing that? Bear with me. Apologize. So hard to see. So sorry. So here's a proprietary algorithm developed and built by our firm. And damn, I wish you could see this better. So the way we built this is super easy. Well, for the back end is quite complex. But basically, green means go and red means no. And we look at 40, 50 different factors, all in an algorithm. Actually, I'll do all the other later. All in an algorithm, and say it makes buy and sell decisions for us. So this is the S&P 500. All these bars are every 5 minutes. When I get a green dot, that means go, right? We think the market's going to go up. And when I get a red dot, that means no. I either get out of the market or short the market entirely and bet against it. So as you can see, kind of like just for visualization purposes, this was today, or this was yesterday around 1 o'clock. We got a convenient little red dot in this area. It told us to sell the market, and the market is pulled back and gone out. That's just looking at all of these different things and coming up with an indication of direction. So what we did is we took this a step further and said, okay, this is great. I can look at this. I used to look at this computer all day long and have to make these trades myself. So I said, all right, I don't want to do that anymore. So I had some developers create an automated strategy. So I click this little button, and I'm going to get into this a little bit more. 2 seconds. Created this little button, and basically what it says is, how many shares or how many contracts you want to buy, what's the value of that, and do I want to activate the strategy or put it on pause? It's that easy. So I don't have to do it anymore. So what I can do, we can have a little fun with this. Say I want to buy 100 contracts of SPY. Let's turn down the time frame so it's every minute, and studies, edit studies.